Most traders stare at a price chart, looking for patterns. But price is just the advertisement. Volume is the actual transaction. It tells you if anyone is actually buying what the market is selling. Take a look at this split screen chart. To read volume correctly, you only need one mental model: effort versus result. Think of pushing a car up a hill. The volume bar is the effort, your foot on the gas pedal. The candlestick above it is the result, how far the car actually moves. Here is the baseline scenario. You press the gas and the car moves easily. Big effort yields a big result. On your chart, this looks like a large candlestick paired with high volume underneath. Everything matches. That tells you there is real conviction behind the movement. Volume provides the record of how much capital is actually being committed to the trend. Before we go deeper, we need to correct the most common mistake traders make. Do not assume that a green volume bar means buying pressure, or a red volume bar means selling pressure. That is not how the data works. Every single trade requires both a buyer and a seller. Volume only counts the total number of transactions. The color of the bar automatically defaults to match the color of the candle above it. Ignore the color completely. Look only at the physical size of the volume bar compared to where the candlestick closes. Stripping away this color bias stops you from falling for false narratives about who is winning. It forces you to look at the raw scale of market activity instead. Now let's test that effort versus result model. What happens when you slam the gas pedal to the floor, but the car refuses to move? This chart shows a phenomenon called absorption. You have extreme effort, a massive volume bar, but almost zero price movement, leaving you with a tiny candlestick or a long wick. Large institutions use their massive capital to quietly set up walls. They absorb panic selling at the bottom of a market, or they trap retail buyers chasing the peak of a rally. The incoming volume hits that wall and evaporates. Take a look at this setup. After weeks of an uptrend, a massive green candle appears on the highest volume of the entire year. Take a few seconds to decide, is this a strong buy signal or a trap? It is a trap. This pattern is known as a buying climax. The massive volume looks like surging retail demand, but smart money is actually using that exact liquidity to unload their positions and sell directly into the crowd. Recognizing absorption keeps you safe. It stops you from acting as exit liquidity for institutional algorithms right when the market is about to turn against you. Single candles tell you what is happening right now, but analyzing a wider trend requires stepping back to track momentum. This chart illustrates volume divergence. Watch how the price continues to make new highs, but the corresponding volume bars underneath are steadily decreasing. The two trends disagree. Think of a rocket launching. As the fuel burns off, the thrust weakens. Even though the rocket is still pointing up, fewer traders are participating. The momentum dies, and the price eventually falls. Tracking volume divergence gives you a predictive early warning system. You can spot exhaustion in a trend long before the actual price chart breaks down. You can put these concepts into practice using a 3-step volume check. Step 1 is to zoom out. Check the broad volume trend on the chart to spot divergences before you ever look at individual trades. Step 2, zoom in to key levels. Watch closely when price interacts with major resistance lines. If you see high volume spikes resulting in small candles, that is absorption. A wall is holding the price back. Step 3, wait for confirmation. It's tempting to jump in the second you see a breakout, but you must wait for the very next candle to prove the market's true intent. That confirmation often looks like a no supply test. Watch for a slight price pullback on exceptionally low volume. That tells you the sellers have vanished, the level is secure, and your entry is safe. Sticking to this sequence replaces the guesswork of chasing price with a repeatable verification process. You move from reacting to the chart to understanding the underlying mechanics of the trade. To review, ignore the color, compare the effort to the result, identify institutional absorption, and never skip the confirmation candle. Here is your volume matrix. Save these specific combinations. High volume and a big candle confirms a healthy move. High volume and a small candle exposes an absorption trap, and low volume on a small pullback confirms a lack of supply. Price can be manipulated to show you whatever the market wants you to see. But volume reveals where real commitment is stepping in, showing exactly where the money is moving.